What is up, Prop Shop YouTube? Austin Trades NQ, founder and owner of the Prop Shop, back with another long format educational video today. Price action trading part 1. So we're going to break this video down into two separate parts, and today hopefully just bring some clarity into overall technical analysis from my system and how I just view the fundamental skills of price action trading. No indicators for the most part, simply viewing price, time, momentum as kind of a holistic whole that we want to develop mastery at reading and understanding. So in this video today, some specific verticals I want to break down for you: context and directional bias, systematic versus discretionary, buyers, sellers, and balance, reading a 5-minute chart, and confluences equal consistency. So without any further ado, we're going to break this video down into those timestamp verticals and start with context and directional bias. So the first thing I'm looking to do within the order of operations in my technical process is recognize context and directional bias. The market's an auction, and if you've watched any videos on this channel, we do break that auction market theory down. Amongst the masterclass videos, trading zones masterclass, technical entries masterclass, you'll hear me talk a lot about the market being an auction. And if buyers and sellers are moving the market based on their conviction in price, an imbalance in buyers, an imbalance in sellers, or an agreement on price, which will eventually break down as balance, then I just really want to establish first and foremost, is there a higher probability that the market's going to be long, short, or neither of those options, right? The proverbial green on the roulette table, which is effectively going to be where we are trading with reduced risk, reduced size in a market that's not clear. However, today, first and foremost, how do we establish context and directional bias? Because we are, more than anything, simply saying, I'm going to place a bet that the market moves higher before it hits my stop here. I'm going to place a bet that the market's going to move lower before it hits my stop here. And if we can determine that the market's either A, moving higher with a 70, 80, 90% probability, or again, moving lower with a 70, 80, 90% probability, that should most likely be the core issue that we're trying to deal with, right? The core question that we're trying to answer. What direction is the market headed and in what time? So for me, context and directional bias are really rooted in that question. Is there an obvious trend higher, an obvious trend lower, and can I establish a little bit of a higher time frame directional bias? But from a technical standpoint, how do we actually do that? Right now, the NASDAQ has been in what I would call very balanced conditions on the daily time frame really since about October of 2025, now February of 2026. And for me, that's established with some simple technical skills and principles that I'm going to break down for you here. Market structure and effectively just supply and demand zones. You're going to hear a lot of people that have different ideologies about trading. ICT, along with supply and demand traders, along with fair value traders, label these things as different words. But what we're establishing is where buyers and sellers are at and where we could trade with fair value. Is the market trending based off structure? Is there obvious buyers at X level, or are there obvious sellers at Y level? And when markets break structure, all-time highs in this case, on Wednesday, August 13th, we made an all-time high, and we broke those all-time highs on Friday, September 12th of 2025. We saw upside continuation here, higher lows, higher highs, but then we made a lower low below that Friday, October 10th, 2025 low. This should have, quote unquote, led to downside continuation if a new trend was going to form. But it didn't. We held this prior all-time high. We closed back above this prior low, and the market saw an upside move. And this is when we can begin to identify higher time frame balance, which is the context we're building for bias. And we're going to break that down again on lower time frames here in a second. Now, again, if we're going to hold this prior all-time high, we talked about this already, this is market structure, then we should, quote unquote, see a new all-time high. Once this failed, we had a higher high, right, but a lower low relative to our local low, and then we got a lower high. So in the past 4 pivots, we've seen higher highs, higher lows. Higher highs, lower lows, first warning sign. And then we saw a lower high. We saw a lower high relative to all-time highs. So now we have 2 warning signs, right? Markets were trending, higher highs, higher lows, higher highs. We made a local lower low, we held structure. and then we put in a lower high. Now, if the markets fail to create a new low or a new high, this is our swing high and swing low for the most recent higher time frame trend. So since this low on Friday, November 21st, 2025, and this high that we created Thursday, October 30th of 2025, markets have failed to create new swing highs and new swing lows in that time frame. This is a technical approach to identifying balanced market context. We do not have a directional bias currently, and then that fuels better decision making. I want to be a buyer in demand and a seller in supply until the market breaks range and sees upside trend or downside trend. In my humble opinion, NASDAQ currently setting up for in the middle of February here, 24,000 as our local swing low. If we get below this and see selling, I do think the market's most likely pull back to these prior all-time highs. And if we hold this level and we eventually see another bounce here, we most likely don't see a triple top here in the markets, and we most likely, again, I'm not going to keep saying quote unquote, but always speaking and thinking in probabilities, get higher highs and all-time high continuation after the fact. But until then, identifying this higher time frame context allows us to make better decisions. And it is February 2025, it's the middle of February, and if you've been trading recently and maybe struggling with the price action on NQ, or maybe having days where the market feels like it's kind of whipsaw up and down, it's hitting your stops, or we're not getting the trend that you're used to, if you're failing to leave the 2-minute, 5-minute, whatever time frame you're on and build higher time frame context, it's going to impact your decision making. Depending on whether you're a systematic or discretionary trader, as we get into that, the first thing I want to do for my process is develop context, develop a directional bias, and I'm doing that through the lens of buyers, sellers, and then balanced markets. The skills that we can use to then break that down and kind of extrapolate this idea into actionable terms is market structure, right? So again, higher highs, higher lows, lower low. So we got a lower swing low, but we held structure. Still not a huge warning sign until we had this lower high. And this is where we would begin to set alerts at swing highs and alerts at swing lows and begin to consider a more defensive approach to trend trading. This is, again, auction market theory and market structure kind of just being represented quickly here in real time on higher time frames. Now, if you're a more systematic trader and you're using, let's say, moving averages on a lower time frame intraday, you can still trade your systematic trend system. But your approach to risk management, your approach to profit management, the skills that I've talked about in the risk management masterclass video, if you haven't checked that out already, the most important video on the channel, I believe you should recognize that your job is not to be fixed in one idea and be a robot, as people try to kind of amorphously say. We're human, we have emotions, and we have the skills, if we focus on them, to understand that being an exponential bet sizing trader, risk on when the markets dictate that your trend system is trending at every level. That's where you're going to make the most money. But if you fail to recognize that context is now balanced and you have a trend following system primarily, then that inability to maybe size down a little bit, right? Take profit slightly quicker, manage risk a little bit tighter, or in extremely volatile markets, widen your stops, widen your profit targets, but consider sizing down to an extent to make up for the volatility. These are skills that come with experience, but we can apply a very systematic lens to our approach, right? Context, directional bias, start on the higher time frames, and view the market as an auction between buyers and sellers so that we can recognize when it's balanced. We can recognize when buyers and sellers are agreed on price, and we can make high quality decisions based on those skills. The next thing I want to get into here, again, is systematic versus discretionary. So we're going to actually go down to a 15-minute time frame. We're going to change this to MNQ. I'm going to continue to break down some of the stuff that I see from a lower time frame perspective and how you could apply a systematic approach to trading a 5-minute chart and how you could apply a bit of a discretionary approach to trading a 5-minute chart. We're going to continue to break down technicals at a higher level, and I'm probably going to go through this pretty quickly. The goal here is to begin to kind of give traders that actually have some market experience insight into a higher level view and long format technical analysis, right? It might sound slightly grandiose, I hope it doesn't, but I'm not trying to explain wedge patterns and heads and shoulders and things that I think a lot of people associate with as being important for their process. Not that it's not. I just have a much more holistic approach on the auction market, and or the market as an auction, excuse me, and I want to see that lens take root in my trading. Buyers versus sellers, sellers versus buyers. Are we balanced or not? And then kind of giving a little bit of a systematic approach to how you can keep yourself in check there psychologically. So this is pretty much what my charts are going to look like headed into the new week for the most part. We're going to add a new zone here live. That's why I just deleted what I deleted. But using the exact same approach that we just took on the higher time frames, I go down to a 15-minute chart. We've talked about this in the trading zones masterclass videos. So again, there's a lot of data here on the channel. I don't need to break all these concepts down on this video, but same ideas apply, right? Recently, the market saw what? Lower highs, lower lows, lower highs, lower lows, lower highs. We actually tested structure here, good example, and then lower lows. Once the market made new structure, which would have been closing back above 780, right? If we held this double bottom and we close back above 780, now the market's potentially making higher relative to this local low, right? Higher highs. So once we got back above this area, we held this higher low. We're maybe going to make a higher high here if we can get above this pivot. And then the market's trending into a potential higher high again at former structure. Notice prior levels stay important. And then we see the market break out into higher highs. And we recognize that we saw a shift in trend that could have been taken advantage of here early into this prior trading week. I'm breaking all this down for you guys in a slower approach to technical analysis now, because all of this is going to make a lot of sense when we break down reading a 5-minute chart from a systematic versus discretionary approach here in about 5 to 10 minutes. So starting this week, which would have been Monday, February 9th, we saw an upside move, and if the markets held above prior swing lows, prior lower highs, then this was probably a really good upside trade above 25,111. This was a trade I actually took in real time. We're going to mark this level out. So this is going to be this prior swing low, 120,111. You get the picture. Same general idea. I would have had a zone drawn here from, if you've watched the videos, candle bodies to candle wicks. This would have been structure. This would have been where I would be looking to trade long above into prior structure. Now, the rest of the week, Monday, we established context and directional bias. We have an upside context and upside directional bias for Monday. How would that fuel our trading decisions? We're going to break down the rest of the week on the 15-minute chart soon, but I'm going to take this is my screens during the day. We're actually going to go ahead and look at MNQ right now instead of MES as well, for the sake of breaking down this video and maybe not necessarily taking too long to do so. But this is going to be a 15-minute chart on MNQ here so that we can actually look at that in real time. And this is going to be, again, a 5-minute chart over here on MNQ as I change this real quick. And then we're going to have a 5-minute chart down here that has EMAs and moving averages on it, because for me personally, it's going to help me kind of build that context and help you guys understand, hey, how could you take a bit more a systematic approach to trading if that's what you do currently. It's a tool that I use to check my directional bias. I think a lot of discretionary traders leave a little bit to be desired when it comes to the fact that, hey, you're a little too discretionary in your approach. Sometimes when we're discretionary, we need to add a little bit more systematic security to our nervous system, meaning for some traders, it's okay to be discretionary and have absolutely no systematic approach to technical analysis, which is largely what EMAs are. But I think for a lot of traders, they would benefit from, at the very least, having kind of a checkbox near their system that says, make sure you keep your psychology intact and you don't put so much burden, so much pressure on yourself to make high quality decisions in every single moment, right? You can still trade price action concepts, which is what we're going to cover here from Monday, February 9th, but you can still use some tools like EMAs, which, as much as they get hate in some areas of the trading community, they are just a guide. They're not a tripwire. You can use them to help make high quality decisions. They don't need to be the be all end all of your trading. And that's how I try to approach it. I think they're a really valuable tool if used appropriately. So now we built context, we understand directional bias. We've talked a little bit about understanding the trend headed into Monday, February 9th. We had an upside bias before the day even starts. Why? Because even though we recognize that on this daily time frame, there is a bit of an established balance, right? We opened up when pretty much in the lower range of that balance, in the above those highs from Friday, right? Friday, we opened up in the lower range. Monday, we opened above Friday's highs. We attempted to, at the very least, close to it. So as we talked about, we're taking this idea, a kind of balanced higher time frame trade on the daily chart, and then trying to apply that context to the 15-minute time frame for myself with extended hours off, where all the volume's at in RTH. Friday, this was the high, and we just talked about that. These were those daily lows that we held, and we discussed that from Thursday into Friday as well. So if we get above 100, 25, 120, then there's probably a high quality trade setup forming to the upside on this 15-minute chart, back into balance on the daily chart, which would be this pivot high, 25,400, 25,500 on the 15-minute. And so Monday's open, we see the market hold the first 5-minute candle. We see a lot of buying pressure come to the upside after the fact. And whether you took the initial long inside of that exact zone we just talked about, or you traded the upside retest of market structure, right? Daily charts, 15-minute charts, we've already broken down some price action concepts. Identify market structure, which is simple higher highs, higher lows, lower highs and lower lows, and recognize how to create trend. And if you've watched the Trading Zones videos, for me, it's going to be candle body to candle wick. And we held this zone beautifully as well. So in my humble opinion, there were two really high quality trade ideas from these exact price action concepts. And whether you use those moving averages or not, again, market structure and retest, this was a retest of this higher time frame market structure as well. The EMAs just provide a systematic approach to trend, right? They're lagging behind price, but they can still be a high probability tool if used appropriately. In my opinion, they are a guide, not a tripwire, meaning they're an extremely powerful tool in trending markets, but we shouldn't fail to take really high quality trades within our playbook only because of EMAs. The same way that, in my opinion at least, we shouldn't only be taking trades because of an EMA crossover. It might be a really strong confluence, and as we continue to read the 5-minute charts, we're going to break that down now. But as a discretionary trader, I'm creating my own zones. I'm developing my own kind of opinion on this higher time frame context, and then applying that lens to this 15-minute market structure and 15-minute trading zones. These are high probability areas where I can most likely trade. And if that happens to be an upside trade above 120 to 100, then price also agrees and is showing strength, and we're trending up on lower time frames, then the moving average is showing strength and trending up. Now provide me a discretionary model, a discretionary approach to higher time frame trading, and just a big green light that's shining bright in your face that says, hey, this is how these can be powerful, right? We understand context. We have a directional bias. And instead of being completely discretionary, we recognize we've done our job as a discretionary trader. We've planned our zones. We're recognizing where there's value and opportunity. And now you can take this 5-minute long. You can take this 5-minute trade long, risking those equal lows and equal lows below. Or we can also do that same thing with a little bit added confluence, a little bit added confidence, so that later in the week, as we break this down, and we're going to do exactly that, we're going to see a lot of the same ideas take place. And that's the core idea of this video as we continue to break down technical analysis. Confluences equal consistency. If I could give younger me as a trader really any lessons as a momentum trader, outside of the core ideas I talk about on this channel, I would distill a lot of it down to confluences and really identifying high quality trade opportunities with confluences. Not to overthink, not to do too much, but to recognize that, hey, if you're above a key level with a higher time frame trend to the upside and those EMAs are sloping up, those are the trades that I want to be taking 100 times out of 100, because I will feel more pain missing out on that opportunity 100 times out of 100 than I would losing on that opportunity. And that's the frame for me that allows me to usually be really successful intraday. So now we're going to go into the rest of the week, right? We see this upside trend continuation Monday into Tuesday's open. Tuesday's open opened at the top of this range. We have this zone right above. And so Tuesday was a bit of a tricky session. We largely saw balance to start the day on Tuesday. Price made lower highs into the 9:45 a.m. time, and we started to see some lower lows form in that same time frame. So this zone here, 25,130, 25,100, now acts as what? Market structure. This is going to be that same level that we're going to use for the rest of the week to identify, hey, If we get below this pivot here, the same pivot we traded earlier in the week, then we're probably going to go test these weekly lows. This is the low from the regular trading hours session on Monday. So as we continue to trade into this, markets gap up on Wednesday. We test this high, and instead of seeing a breakout, higher time frame daily trend is balanced. We see a rejection of highs, a trend to the downside. We briefly sweep this prior pivot, and then we see the market move higher. This is contextually, pretty tricky action on the 15-minute time frame. This gap up and sell, great trading day from a momentum standpoint, but we're going to try to break down some higher time frame concepts and make this a little bit more systematic. Once we finally traded below 120 into Thursday, and we stayed below this level into Thursday, Friday, this is what I want to highlight as being a really valuable trade idea, because we had clear and obvious trend below 120 and continuing to see that trend below these weekly lows, right? That's what we talked about. Using these market structures to build context, directional bias. So once the market started trading below this low again, and we failed to see higher highs throughout the week, we can look for shorts and trade into those pretty confidently if we have both a discretionary and systematic confluence to back it up. So we're going to go into Thursday and Friday at the end of the week. We're going to kind of break down some of the trade ideas that I see both systematically and discretionary. And then we're going to highlight, again, those 5-minute candle opportunities and hopefully wrap this up a little bit with those confluences being the most important idea of this video, right? So Thursday, we finally see a close at 7:30 a.m. below this on a 15-minute time frame, but there was clear and obvious selling into this on Thursday. I really like this flag pattern as an actionable trade idea. I think you could take this trade short on a 5-minute candle close, risking a close above for 40 points, targeting a new low for 60 points. It's great R on that trade. And then we see a close below that level we just talked about, right? Markets trade below it. We see a close here, probably risking 25 to 30 points there to get a new low. And you can continue to see how just using confluences of trend, directional bias, and even if you were to wait, I do think this was a great trade, but even if you were to wait for that specific zone to hit, we got another 5-minute candle opportunity to be short, trade the market to the downside, see more opportunity based on this higher time frame level. Into the next day, Friday, February 13th, 2026, what did the market do? Very tricky action to start the session. We actually saw, in my opinion, very seek and destroy type of action here, where the market was whipsawing highs and lows of the overnight range. We moved higher, we moved lower. So is there trend here if the dominant trend is down on the 15-minute time frame? No, right? We held this prior 15-minute low that we talked about. Markets were indecisive for the first 30, 45 minutes of the day. And once we got back up to this high, this same level we're talking about, we saw a rejection. If we get above that specific zone, or we start to see higher highs, then maybe we can trade back into the balance of that weekly range. Because again, the daily chart is balanced. So we're not looking to leverage into any of these setups extremely aggressively until we see those tail trades start to take place, which for me would have been breaking above this high into the daily highs, or breaking below these lows into the daily lows. So knowing what we know now, looking at the 950, 25,000 area, this could have been a good area to potentially look for longs back into structure. And I see a 5-minute opportunity that I traded on Friday that I thought was really A+, really opportune, had multiple confluences. So we broke above that zone that I'm talking about, right? We had a pretty clear and obvious break of structure here. And then what I see on multiple different time frames is, again, a break above these prior highs. So we see a new high. And once we see a new intraday high, a new 15-minute high, the first thing I'm looking for is a pullback to market structure. And that's exactly what we got. So I'm going to delete this level for now just to kind of give some context and not confuse anybody. This intraday high lined up with these weekly higher or lower highs. That was also around this weekly low, and we had multiple reasons to be short there the prior day. So if we get above that and we hold it, we have multiple reasons to be long there, right? Sellers become buyers on the retest. So when we held this prior pivot, I went long here. We got a beautiful trade out of this. We actually did make a higher high, albeit very briefly, before we saw more selling, indicative of that daily chart being balanced, right? A lot of breakouts failing recently on the NASDAQ. So this was a really beautiful trade. Like I said, multiple confluences on the 15-minute time frame, things that pay the bills. We could break down probably 20 plus technical opportunities to trade on NQ, ES, and GC last week, but I want to really get into the main verticals of this video. As a price action trader, I'm going to end up repeating a lot of the same things in an individual video because context and directional bias are really what I'm looking for to start being an aggressive trader, an aggressive momentum trader. If I have a strong higher time frame trend in the context, meaning right, the daily chart's trending higher, the 15-minute chart's trending higher, that's when I show up every morning really putting my foot on the gas, really looking to be aggressive, really trade my process confidently. Not that I don't trade confidently other days, it's just recognizing that I'd say 50 to 60 to 70% of the time, the markets are noise, they're entropy, they're doing things that are just random and not necessarily being extremely efficient for my playbook and my edge. I'm still watching, I'm still observing, I'm still hunting and waiting for my opportunities, but I don't want to participate. I don't want to press buttons until there's obvious directional bias, until there's obvious buyers or sellers in control with confluence of that directional bias, right? And if I can read a 5-minute chart at a high level, that's fine. But I can't just take every flag pattern, every EMA crossover, every wedge, whatever your technical playbook is, every second buyer, second seller when I see it. I build context. I establish directional bias. And once you do that, hey, if we think the 15-minute chart is going to trade long for the next 30 minutes and your playbook provides you a really high quality opportunity, that's when I'm trading. That's when I'm looking to put my foot on the gas, so to speak, and execute at a high level. Confluences equal consistency. And the more we can put ourselves in a position of trading with the higher time frame trend, but doing that on the lower time frame with multiple confluences, I have found in my trading experience that produces the most consistency of the experience itself, meaning my internal environment is joyful. I'm calm, I'm managing my risk, I'm managing my profit, and I'm doing it out of a state of joy. Versus pushing, right? It's leaning into your screens, focusing too much on what you're doing, pressing too many buttons, taking too many trades, not objectively reading the market. We've all been there. I want to feel a pull to take great trades. And for me, the pull that I feel to take great trades happens after I establish this directional bias, after I establish context. I recognize who's in control of the trend and where. Buyers, sellers, or are they in agreement completely? And as we've talked about already, using market structure skills, the daily chart on NQ is very much balanced, right? Look at May to August of 2025. This is the stuff where I really put my foot on the gas and made money to the long side. Recently, a little bit more defensive approach to trading. That comes from context and directional bias. You don't need to be completely discretionary to do this. Use the tools in your playbook to your advantage to not, again, completely rely on them or trip up on them, as I've already spoke about. EMAs can be a great tool, as many things in the market can be, if they're a confident and intentional part of our process. I've explained a lot of technical things in this video regarding a 5-minute chart, but I hope more than anything, you build context and directional bias, you use confluences to your advantage, and you have a safe and confident trading experience day in and day out. If you've been enjoying these videos, please like, subscribe, leave a comment. A lot of stuff coming in the future. The Prop Shop is releasing a ton of content with news coming soon. Again, trade safe, trade smart. Thank you for tuning in. Peace.